Public finance refers to the management of a country's revenue, debt, and expenditure, as well as the proper management of government's budget to achieve governmental goals and objectives, and to avoid the mismanagement and abuse of government resources. This video provides a basic introduction to public finance. So, subscribe now, and let's explore this concept of public finance by covering the following. Starting with the definition of public finance. We'll also discuss the scope of public finance by explaining the various components of public finance. We will further dissect the various objectives of public finance, and also differentiate between private and public finance. We'll then conclude our video by highlighting the significance and importance of public finance in a country's development. So, without wasting any more time, let's get into today's video. As an introduction, we should mention that public finance is the cornerstone of a government's well-being. This is because it delves into critical questions of how governments raise money and other financial resources, and how it allocates such funds and resources to ultimately influence the economic and social landscape. Let's now define this concept called public finance. Public finance can be broadly defined as the study of government activity in the economy. Public finance encompasses how governments raise revenue, primarily through taxes and investments, how they allocate those resources on infrastructure, education, healthcare, or any other public good, and how they manage their budget and debt. Unlike private finance, which focuses on profit maximization, public finance prioritizes achieving societal goals, such as economic stability, income redistribution, and the provision of public good. Later on in this video, we discuss more on the difference between private and public finance. But for now, let's take a look at how various scholars have defined public finance. According to Hugh Dalton, public finance is concerned with the income and expenditure of public authorities, and with the adjustment of the one to the other. Richard Musgrave, on the other hand, stated that the complex of problems that centers on the revenue expenditure process of government is referred to traditionally as public finance. While F.E. Taylor held that public finance studies the manner in which the state through its organ, which is the government, raises and spends the resources required. Public finance is thus concerned with the operation and policies of the fiscal public treasury. It can be summarized from these definitions that public finance is a term used for financial management in the public sector, including in governmental affiliated organizations. Simply put, public finance monitors how government collects its revenue, and how it manages its budgets, its debts and expenditures, towards developing the lives of the public and improving the country's economy. Hugh Dalton, who we mentioned earlier when discussing the definition of public finance, categorizes the scope of public finance into four components, which includes public revenue, public expenditure, public debt, and financial administration. Let's now briefly discuss each of these components, starting with public revenue. This refers to the income collected from various sources by the government or the public sector. It includes revenue collected by way of taxes, imports on duties, tariffs, indirect taxes, penalties, fees, maintenance, grants, income from investments, etc. In some countries, the government also engages in certain strategic commercial activities to earn revenue. Public revenue, as a study, is therefore concerned with various ways the public sector raises and collects revenue. Public revenue is also concerned with the principles and effects of taxation, and how the burden of taxation is shared among the various classes of society, amongst its other focus. The next component of public finance we'll discuss is public expenditure. This refers to the total spending by the public sector on various goods and services to fulfill its governmental responsibilities and to also meet the needs of the public. As the name suggests, public expenditure encompasses various governmental expenses such as infrastructure, medical and healthcare facilities, technology, education, welfare, and more. Public expenditure also plays a crucial role in the functioning of an economy, because it has an impact on economic growth. Public expenditure can further be divided into two categories. Operational expenditure, which includes day-to-day expenses such as salaries of government employees, maintenance of infrastructure, and administrative costs. As well as capital expenditure, which is used for long-term investments in infrastructure projects like roads, bridges, schools, hospitals, and other public facilities. These investments are aimed at improving the economy's productivity and the quality of life for citizens. The study of public expenditure deals with the principles relating to the allocation of public spending, as well as principles governing the flow of public funds, including the justification of public spending, and measures adopted by the government to ensure that spending is conducted efficiently, effectively, economically, and within the law. The next component of public finance we'll discuss is public debt. Public debt refers to the total amount of money that a government owes. This debt can be categorized into various types, starting with internal and external debt, where internal debt refers to funds borrowed domestically, often from banks, businesses, and individuals within the country, and external debt, which refers to borrowed funds from foreign entities, such as international organizations like the World Bank. Public debt can also be categorized into compulsory and voluntary debt. Compulsory debt includes obligations that the public is required to pay, such as taxes. Voluntary debt, on the other hand, includes debts where commercial banks voluntarily subscribe to securities issued through government loans. Public debt can also be regarded as either redeemable or irredeemable debt. Redeemable debt, on one hand, is repaid by the government after a specified period, often involving the sale of securities to the public. Irredeemable debt, however, lacks a promised repayment date and is not reported by the government. Public debt is therefore a study of various principles and methods of how government raises debt and the economic effects thereof. This area of public finance also deals with the various methods of repayments and management of public debt. The last component of public finance we'll discuss is financial management. Financial administration refers to the management of public finances. This includes preparation, passing, and implementation of government budget, budgetary policies, and their socio-economic impact, intergovernmental financial relations, fiscal management, and fiscal responsibility. It also refers to the needs of the government. In this next section, we'll discuss some of the primary objectives of public finance. One of the main objectives of public finance is to manage the basic needs and requirements of the public, including the need for health, housing, education, infrastructure, public safety, national security, etc. When public needs are timely met, it contributes to economic growth, development of the country, as well as an improved quality of life for citizens. Effective public financial management also results in economic development, eventually contributing to the nation's overall growth trajectory. Another important objective of public finance is that it aims to reduce inequality through the optimum allocation of resources. This involves implementing measures such as progressive taxation and provision of welfare grants and subsidies to assist disadvantaged segments of society, thereby promoting social cohesion and fairness. Public finance techniques and measures also help to control inflation and maintain price stability. Other functions of public finance include meeting the primary requirements of the country, generating employment opportunities for its citizens, and maintaining the value of the currency in the global market. In the next section, we'll break down some of the differences between private finance and public finance. However, before we continue, we'd like to take a quick moment to ask for your support. If you find this video helpful, please give it a thumbs up by clicking that like button below. And if you haven't already, consider subscribing to our channel. By subscribing, you'll never miss out on our latest content. Remember, hitting that subscribe button is free, and it shows us that you appreciate what we do. Now that you have subscribed, let's get back to today's video by discussing some of the differences between private finance and public finance. Although both these areas deal with financial resources and financial management, they differ in terms of scope, objectives, sources of funds, and decision-making authority. So, here are some of the key distinctions between private finance and public finance. In terms of scope, private finance concentrates on the financial activities of individuals, households, businesses, and non-governmental organizations. It also deals with personal financial management, corporate finance, investments, and financial transactions in the private sector. Public finance, on the other hand, deals with financial activities of governments at various levels of government, either central, state, or local government. It further involves the management of public revenue, public expenditure, and public debt, and also encompasses fiscal policies and decisions made by the government. The primary objective of private finance is to maximize individual or organizational wealth and financial well-being. Private finance also aims to optimize personal savings, investments, and financial decisions to meet personal or business objectives, such as profitability, growth, or wealth accumulation. The objectives of public finance, on the other hand, are broader and include ensuring economic stability, promoting equitable distribution of resources, providing public goods and services, addressing market failures, and enhancing the welfare of the population. Public finance also focuses on achieving collective goals rather than maximizing individual wealth. Private finance derives its funds primarily from private sources, such as personal savings, bank loans, equity investments, bonds, or other forms of private financing. It relies on voluntary transactions and the participation of private individuals, organizations, and financial institutions. Public finance, on the other hand, relies on public sources of funds, mainly derived from taxation, government revenue, fines, and borrowings from domestic or international sources. Public finance mostly relies on compulsory contributions from the public to finance government activities and the provision of public goods and services. In private finance, individuals and businesses have the autonomy and decision-making authority to manage their financial resources according to their own preferences and objectives. They also make decisions on savings, investments, borrowing, and financial planning based on market conditions and personal or business considerations. In public finance, the government, and those charged with the responsibility, have the decision-making authority to formulate and implement fiscal policies, determine tax rates, allocate public expenditure, manage public debt, and regulate the overall financial activities of the public sector. Public finance decisions are mainly influenced by public policy objectives, political considerations, and the need to address collective needs and public interest. Accountability and transparency in private finance primarily involves individual and organizational obligations towards stakeholders, shareholders, and sometimes regulatory authorities. Disclosure requirements, including adherence to legal and ethical standards of financial reporting, are also essential aspects of private finance. Public finance is no different, but requires a higher degree of accountability and transparency due to the involvement of public funds and the responsibility of governments to its citizens. Government officials and governmental institutions are accountable to the public and subject to scrutiny and oversight by legislative bodies, auditors, and the general public. Public financial management systems, therefore, emphasize transparency, proper governance, and public accountability. Public finance plays a vital role in a country's development. This is because it forms the backbone of governmental operations and policymaking, influencing all governmental sectors including education, healthcare, infrastructure, defense, to list just a few. Here are just a few ways in how public finance plays a crucial role in the development of a country. Proper management of public finance can promote economic growth through targeted spending on infrastructure, education, as well as on research and development. Public finance tools, such as proper fiscal policy, can also be used to manage economic cycles by mitigating the impact of recessions and promoting economic stability. Governments can also use public finance strategies to reduce inequality and redistribute wealth by implementing measures such as progressive tax systems, as well as issuing welfare grants and subsidies, as an example. One of government's function is to finance essential public goods, such as the national defense, public safety, and basic infrastructure, which the private sector might not efficiently provide. So, proper management of public finance is significant because it ensures that these public goods continue to be provided, and sometimes at little to no cost to the public. We've come to the end of our video, which provides a brief introduction to public finance and its significance and importance in a country's development. By the way, if you haven't noticed, we often provide links to the various sources used in our videos. You can find the various sources in the description section below. So, thank you for watching, and if you found this video insightful, you can also check out these other videos under our channel, which form part of our playlist on public finance. We'll also pin the link to the playlist in the comments section below. Also remember to like and share this video to show your support. And subscribe to our channel for more content. Kano Consultants, for professional advice you can trust.